Welcome to Financial Perspectives, the podcast, where we cover timely topics related to the current economic environment and keep you up to date on investment news. We also provide insights on how investors can maintain a long-term perspective. Please stick around at the end for important disclosure information. More information about Foster Group can be found in our ADV brochure at fostergrp.com.
So, the trouble with tariffs, are they on? Off? On again? To what extent? And what does all this mean for my investment portfolio? We hear questions like that all the time these days. The new Trump administration, like it or not, likes to move fast and seems to course correct every day, even within the same day, with policy announcements, revisions, executive orders, and more. And there's probably no better example than the variety of tariffs being announced, implemented, delayed, and modified. A recent look at the Wall Street Journal's online Trump tracker and Bloomberg's online homepage both were trying to give readers an up-to-date accounting of the current status of various tariffs and related negotiations. In this current round of tariffs, President Trump has indicated that he plans to put tariffs on imports from Canada, Mexico, and China, effectively raising the cost of importing at least some goods from all of these countries. Of course, those countries are threatening a set of retaliatory tariffs on U.S. exports to their country. One thing is clear, tariffs, no matter how carefully messaged, have the effect of immediately increasing costs for someone. And those costs will likely be borne by either companies who may accept lower profit margins and earnings, or consumers who will be asked to pay higher prices, or maybe a bit of both. President Trump alluded to this reality in his speech to a joint session of Congress when he said, quote, "We may have in the short term a little pain, and people understand that," unquote. JP Morgan's chief global strategist, Dr. David Kelly, had this to say about tariffs, quote, "The trouble with tariffs, to be succinct, is that they raise prices, slow economic growth, cut profits, increase unemployment, worsen inequality, diminish productivity, and increase global tensions. Other than that," he said, "they're fine." He probably won't be invited to Mar-a-Lago anytime soon. The rate and unpredictability of policy announcements makes it very difficult to accurately predict how much economic pain will ultimately be experienced, and for how long, and by which companies and which countries will be the most affected. This uncertainty, which investors, and by extensions markets made up of investors, they don't like that. It's been evident in the upward trend of the VIX, a volatility measure of the U.S. stock market, which has risen just over 37% from 14 to 23 since Valentine's Day. In the big picture, the thing to keep in mind is that this recent threat of tariffs and their predicted impact is just the latest example of an endless string of circumstances that leave investors wondering, but what does this mean for my portfolio? Am I going to be okay? Investors asked the same question when President Trump was first elected in 2016, and again when he implemented tariffs on foreign steel and aluminum in 2018. We couldn't stop asking this question in 2020 as the world grappled with COVID-19. We asked the questions when President Biden was elected, and again when Russia invaded Ukraine in 2022. And then again when inflation ran up to 9% and the Fed took actions that raised short-term interest rates from virtually zero to over 5% in 2022 and 2023. We asked these same questions again when Israel retaliated against Hamas over the terrorist violent incursion, and again when President Trump was reelected in the 2024 election. When we stop and think about just the last 10 years, it's been one seemingly seismic event after another. And while the list I just read is not a complete one, over those same 10 years, markets around the world, they've positively rewarded investors, with the U.S. clearly leading the way. So, what should an investor be doing in the face of this latest round of uncertainty? Well, at the risk of sounding like I'm offering an oversimplification, diversification is still the best answer to guarding your portfolio from both known and unknown threats, foreign and domestic. The benefits of diversification include, first, avoiding extreme losses that could come from being overinvested in the wrong thing at the wrong time. Another less talked about goal is to increase the likelihood that the portfolio will own and benefit from the next set of winners, including the unexpected winners who maybe were off the radar. A third benefit is the lowering of portfolio risks, including volatility and a lack of timely liquidity. 2025 so far has not looked like 2024 in terms of winners and losers. If an investor was only invested in 2024's two biggest winners, U.S. large and small company stocks, they would own the two worst performing major asset classes in the first 2 months of this year. After years of underperforming U.S. stocks, foreign large company stocks have been the best performing asset class of 2025. That's so far, and it's still early. But large foreign stocks are up over 8% this year, while the S&P 500 was down about 1.5%. This was as of Friday, March 7th, 2025. Here's the basic message in favor of broad diversification. If you don't know exactly what is coming in terms of global economic or geopolitical events, either positive or negative ones, you want to be invested in things that are different from one another. In plain language, we don't want all our now more expensive eggs, thanks to avian flu, in one basket, because we don't know which basket will do well as circumstances change. In this case, the full reality of tariffs is yet to be known. So instead of trying to own only the one highest returning thing, like the best stock, the best country, or the best sector, the one that might go up the most, we should want to own things that go up even when other things are going down, and to be okay with owning things that may go down while other things are going up. In statistical language, we want to own a portfolio of assets, all with positive expected returns, but which are not highly correlated. Ultimately, all the asset classes we invest in should have positive returns. They'll just get there on different timetables. This means that our portfolio, while never being the best performer compared to every asset class, will also never be the worst and will likely have lower levels of volatility, what we feel like risk. So why does diversification work for investors? Well, it has to do with the statistical concept of correlation. Two assets which are perfectly correlated, meaning that when one goes up, the other goes up exactly the same amount at exactly the same time, well, they have a correlation coefficient of 1. When one goes up, the other always goes up. Statistically, in this case, the second asset adds no diversification benefit to the portfolio. If the correlation coefficient between assets is close to 0, it means the two have return patterns that are impossible to predict based on what either one is doing. They may go up or down at the same time, or one may go down while the other is rising. Assets that are non-correlated provide real diversification benefits. Assets that are perfectly negatively correlated have a correlation coefficient of a -1 and provide absolute diversification, in effect canceling each other's returns out. In the real investment world, most pairs of assets turn out to be positively correlated to some degree because they all have long-term positive expected returns. As an example, historically, stocks and bonds have had a very low correlation to each other. The Russell 1000 index of U.S. large company stocks and the Bloomberg U.S. Aggregate Bond Index have had a correlation of around 0.22 since 1988. Short-term bond returns have an even lower correlation to stocks. The ICE Bank of America 1 to 5 year U.S. Treasury Note Index has had a negative correlation of a -0.01 with the Russell 1000 since 1988. That very slight negative correlation coefficient doesn't mean short-term treasuries can be relied on to always go up when stocks go down, but they are more likely to perform differently than stocks. Usually bonds, and especially short-term bonds, have done well when stocks are under duress. Now I have to say usually, because in 2022, we were reminded that very few things aside from death and taxes are always true. Both stocks and bonds declined precipitously in 2022. This exceptional year doesn't invalidate the norm, it just reminds us that anything can happen. Among stock asset classes, for example, U.S. large companies and U.S. small companies, there is a positive correlation, but it's less than perfect. The correlation coefficient since 1988 has been around 0.85, fairly close to 1. This means they usually go up or down at the same time, but not always, and not always to the same degree. Foreign stocks are even less correlated with U.S. large company stocks, with a correlation coefficient of about 0.75. So, back to tariffs and what will happen next. It's unlikely that anyone's crystal ball is clear on that. What we can be confident about is that after the uncertainty of tariff policy fades, there will be another issue that arises, one which seems to threaten markets and investor portfolios. What is clear is that portfolio diversification is a bit like insurance. If we are diversified at all times, we may feel good or bad, but in times of volatility, we experience the benefits, especially when what was the winning strategy loses a bit of its luster, like the Magnificent Seven stocks, which are down this year an average of just over 10%, and when assets that were unpopular, like foreign stocks, suddenly become return leaders. Tariffs are just the latest example of reasons why staying diversified helps create resilient, long-term, goal-achieving portfolios. Diversification helps us statistically, and in tough markets and uncertain times, it should help us feel a little bit better too. We've seen things like this before, and we'll certainly see them again, but a look in the rearview mirror reminds us that markets have a way of adjusting to the current realities, political and economic, and providing patient and optimistic investors with positive returns. Today, as much or more than ever, developing an educated optimism is an antidote for anxious uncertainty. And it's certainly a financial perspective worth pursuing. Thanks for joining us today. If you have any questions or comments, you can reach us at www.fostergrp.com. We'd love to hear from you. So until next time, be optimistic and stay diversified.
The previous presentation by Foster Group was intended for general information purposes only. No portion of the presentation serves as the receipt of, or as a substitute for, personalized investment advice from Foster Group or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy, or any non-investment related or planning services, discussion, or content, will be profitable, be suitable for your portfolio or individual situation, or prove successful. Foster Group is neither a law firm nor accounting firm, and no portion of its services should be construed as legal or accounting advice. No portion of the content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Foster Group is engaged, or continues to be engaged, to provide investment advisory services. A copy of Foster Group's current written disclosure brochure discussing our advisory services and fees is available upon request or at www.fostergrp.com/disclosures.